Okay, so shareholder wants director work in a best interest of shareholder. And what director wants? Director want to work in a self-interest of himself. So same sounds here, self-interest sounds is like as earning management that we discussed when we talk about unethical standard, unethical behavior. So director gonna implement such kinds of policy and procedure, they're gonna give personal benefits to them. All right, or director wants that whatever they do in an organization that give them benefit first and then later on give benefits to shareholders. So they are looking at themselves first, directors. All right, this kind of situation called agency gap. We also call it conflict of interest. Conflict of interest is there is a conflict between shareholder and director. Why? Because shareholder and director, their desire is not the same. They're different. What shareholders want something from director and director wants something else from shareholders. They are both are not in the same situation. Obviously, we are looking at the director because as what we'll study before, director is supposed to work in a best interest of shareholder or maximizing the value of shareholder. So this is called a agency gap or conflict, agency conflict, you can call it. Now, what are the consequences? Agency cost. What are the consequences of this conflict or of this gap? The consequences could be a loss of shareholder wealth. If director is not working in a best interest of shareholder, if he or she is working in a best interest of themselves, then obviously it's giving a negative impacts over the firm financial performance. If firm financially perform bad, shareholder will lose their investment. Shareholder will lose their wealth. So that could be an agency cost, or that could be consequences of this agency gap. Right? Now, the third thing is how to minimize such kinds of agency gap or agency problem. In order to minimize, we have one solution. The solution is an incentive plan. Incentive plan. Incentive plan means director's salary must be tied up to share price. All right. Director's salary must be tied up to the share price. So it means if share price goes up, director will get more money from shareholders. If share price goes down, director's salary will be negatively affected. All right. So such kinds of incentive plan will encourage director to work in the best interest of shareholders. Why? Because share price is maximizing the wealth of the shareholders, value of the firms. That's the best interest of the director. All right. So we can overcome the self-interest issues by tidying up the salary or the remuneration of director to the stock price. All right. Always remember, we may not minimize, we may not able to remove this agency gap 100%, is always exist. But of course, by applying this incentive plan or some other kinds of plans, we can, of course, we can minimize this agency gap or agency problem. All right. So that's all about agency relationship. Right? So agency relationship is finished. So anybody has any question? Any question? Yes or no?
No. No, teacher.
No questions. So if no question, we stop here this session. So topic 1 is finished. Topic 1 is finished. So in next lecture, we will start with topic 2. All right. And I guess next class is not an online class. It will be offline in university, right? Can you please confirm? Can you please confirm whether next week is the online or offline? I guess it's offline, right?
It's offline.
Yes, offline. So in university, all right? So we stop here. So I'll see you next week in university. So make sure you be on time. Don't be late. Otherwise, you lose your attendance, all right? So we stop here. I'll see you next week. Thank you. Bye-bye. Okay, so now let's move on to the last point for topic 1, which is about the agency relationship. Now, what is agency relationship? Agency relationship indicates the relationship between principal and agent. Principal and agent. Here, the principal means shareholder. And here, the agent means a director. Okay, that's called the principal-agent relationship. Shareholder, director relationship called agency relationship, or whatever relationship they have. So in order to understand this relationship between principal and agent, we're gonna have a look 3 different things. So the first thing is a agency problem. Agency problem, or we call it agency gap. Second thing, we look at is a agency cost. Agency cost. And the third thing that we look at, how to solve agency gap. How to minimize agency gap. All right. So 3 different things we're going to look at one by one. So let's look at the agency problem. Okay. What is agency problem? Agency problem arises when the desire of shareholder and director are different. All right. So let's take example here. Shareholder. And we have a director. What shareholder wants, we are discussing about Desire, or we're discussing about want. What shareholder wants from director? Shareholder wants that director work in the best interest of shareholder. That's what shareholder want. That's the desire of shareholder towards director, that director work in a best interest of shareholder. In simple language, director work hard or puts its efforts to maximize the wealth of shareholders. That's what shareholder expect from the director. And what director wants? Director wants to work in a self-interest. Okay, so let's move on to the next, which is insider trading. So we are talking about unethical behavior. So insider trading. So this insider trading is related to the stock market. Now, what is insider trading? In order to understand insider trading, let me give the example. For example, I am a CEO or the director of one company, local company. And my company going to collaborate with a foreign company, and that foreign partner is very big a partner. And you know that this is a good news for my company stock price. So means if I release this information in a market, my share price will go up, and that's good, all right? But here, what I'm going to do, once I confirm the deal with the foreign partner, or I know that maybe next week I'm going to make a deal with the foreign partner. So next week, if I inform this information in a market, my stock price will go up. So now what I'm going to do, before I release this information in a market, I tell my friends, my relatives to buy my company stocks. Because right now, stock price is here. So when I release information that my company is going to collaborate with a foreign partner, stock price will be here, or maybe more than that, right? So I am going to tell my family members to buy that company stocks. So they are buying my company stock right now, which is, let's say, $10. And next week, and they're going to invest a huge money. So next week, when I will disclose this information in a market, my stock price will go up. And all my friends and relatives, they're going to make a lot of money overnight. All right. So this sounds completely unethical. Why? Because according to the stock market rules and regulations, we must provide informations to the market as soon as possible, to the people, to the public, right? We should not keep or hide information at our level. We have to maximize the transparency between companies and the market. If there is a high transparency in a market, the probability of scandal, bankruptcy, or economic crisis will be decreased. And if there is a high transparency, the users or the investor in a market, they have a full information. If they have full information, they will be actively involved in investment decision. Because if we have a partially information, if we have an incomplete information, we're not gonna able to make a decision. We have to wait to get the full information. So if you transfer more and more information in a market, stock market gonna be active. Stock market gonna active, investment activity will increase in a market. Investment activity increase, obviously manufacturing sector or other sectors, they got fundings to run themselves. As a result, they will maximize their manufacturing, country production will increase, GDP increase, and export, and so on. As a result, company economy will go up. All right. But if there is any kinds of incomplete information, wrong information, or used information, that may give a negative impacts on the stock market. All right. So that's why insider trading is illegal or unethical. Insider, as you can see the name insider trading. Insider means within a company, you use information inside and then you disclose in the market. That's not right. All right. Now, next is a fraud. Fraud means cheating. Cheat, right? Doing anything bad, right? Cheating means taking an unfair advantage of someone else, right? So maybe you're stealing a company assets, maybe use company assets for personal purpose, or stealing company cash, anything, doing fraud and cheating. So that's completely unethical. And the last thing, last example for unethical behavior is a bribery. Bribe, right? So bribe means when you give money to someone, but in exchange, you do not get any evidence for giving that money. Why you don't want evidence? Because you want some particular favor from that person. So let me give you an example. For example, let's say I'm riding a motorbike and I break a traffic rule. The policeman stopped me, all right? And I give bribe to the policeman. Bribe means, for example, I give money to the policeman and policeman let me go. But when I give money to the policeman, why we call it bribe? When I give money to the policeman, in exchange, policeman is not giving me any kinds of receipts or any kinds of evidence or any kinds of paper that you are giving money. So I am looking for a favor from the policeman. So I am supplying money to the policeman. In exchange, policeman is not giving me any kinds of favor. That's example of bribe. But if I break the signals and I give money to the policeman, in exchange, policeman will give me a tickets or any kinds of receipts that I break the rule. So that money is not going in policeman pocket. That money is going in a government account. And that's good. So bribe is illegal as well as unethical, right? Because we don't have any kinds of evidence for it, right? So that's called these are the examples for unethical behavior. And obviously that bribe things also happen in all kinds of department. At some level, it's very small. At some level, it's really huge. And again, it also depends upon countries to countries. In some countries, that's bribe is corruptions is very low, and in some countries is very high. Like for example, I guess is Laos. It's a country where is a high level of corruptions. Anyway, so let's move on to the. So that's all about the unethical behavior. All right. So unethical behavior is finished. Let's move on to the next. So before we move on, anybody has any question? Any question or we move on?
No, teacher.
Okay. So no questions. So let's move on to the next. Now, next is a managerial finance function. Managerial finance functions. Now, what is the meaning of this? In simple language, managerial finance function means what are the function of financial manager? How are we gonna manage our finance? So the major function of financial manager is to control over financial activity. To look after the financial activity. So in order to look after the financial activity, here we have to, how can a financial manager look after the financial activity? So financial manager look after the financial activity by making some kinds of decisions. So here financial manager gonna make two kinds of decisions. One is a financial decision, and another one is a investment decision. Financial decision and investment decision. Now, what is financial decision and what is investment decision? Financial decision can be understood by looking at two things, which are current liability and non-current liability. What is the meaning of non-current liability? Look at non-current liability first. Non-current liability means long-term liability that company need to pay off in future with interest. That's called the non-current liability. So the best example for non-current liability is a bank loan. Company borrow money from bank and company has to return that money back to bank with interest in the future, in a long run. So we also call it long-term liability. Now, what is a short-term liability or current liability? Current liability are those liability, we also call it short-term liability. Short-term. So current liabilities are those kinds of short-term liability that company need to pay off within a short period of time. So it means company require cash on daily basis. How can company get a cash in order to dispose your current liability? So that's the decisions financial manager need to make in short period of time. All right. And in long period of time, how company will have a cash when due dates will come to make a payments for bank loan. How company gonna get that money? Let's say I borrow $50,000 from bank and I invested that money, and 5 years is a due date, all right, or maturity date. After 5 years, I have to return that $50,000 back to bank with interest. So after 5 years, how I will have a money? Do I will have a money to return money back to bank or not? That's kind of decision financial manager need to make. That's called financial decision. So financial manager is involved in making short-term decision that belongs to current liability on a regular basis. We need a funding. How can we get the fundings, right? And long-term decision. In future, in long run, when due date will come, how can we get the money to return money back to the bank or someone else where we got the money or we borrowed the money, all right? So this is called a financial decision, right? So now we move on to the next one, which is investment decisions. Investment decision is a combination of two things here. One is current assets, and the other one is a non-current asset. Now, what is non-current assets? Non-current asset is the asset that we require to run the business. Or in other words, buying non-current assets means an investment. Remember that. So buying assets called investment. Investment of what? Investment of money. Capital investment. Also call it capital investment. We got capital, right? We got capital from, as you know, bank loan. We got some funding from bank loan, and we got money from shareholders, right? We got this money. That's called a capital. And when you invest this capital, means buying assets. So what is the investment decision here? Investment decision is which types of assets we should buy, or in other words, where we should invest, or which type of assets we should buy. That kind of decision will be taken by the financial manager. This is also called long-term investment. All right. Okay. Non-current means long-term. Like as non-current means long-term liability, this is also called long-term investment. Now, current assets. Current assets means any kinds of investment you can dispose in short period of time when you need money. Or in other words, we can say that on daily basis, on regular basis, we need money. On daily basis, we need money for what? We need money for this on regular basis. So where we can get the money? We can get money to this current assets. So the best example of current asset is current assets involve cash. Company always keeps some cash in order to make a payments for short-term liability. All right. So how much current assets company should maintain? That decision will be taken by financial manager, and that decision called short-term investment decisions. And how much assets or which types of assets we should invest in a long period of time, that's called the non-current assets. I can give you a quick example of non-current assets: land, building, plant, machinery, furniture, vehicle, tools. All these things require all these kind of things to produce product, sell product, right? So that's why this is called a future investment. So we are investing money all in these resources so we can produce product, sell product, make profit. That's the purpose of investment, to make profit. So that's what exactly we are doing here by buying assets. So this is called a long-term investment. And that decision will be taken by the financial manager. So this is called a managerial finance function, right? So managerial finance function is finished. So any question?
Teacher,
Yes.
can you hear me?
Yes.
Can you post this clip on YouTube, please, so
Yes.
we can watch it?
Yes. I'm recording, and once I finished, then by tonight or tomorrow I will upload on YouTube. Yes. Same like as the previous lecture.
Yes, thank you.
So anybody has any question, or now we go for break for 15 minutes? So no questions. So we go for break for 15 minutes. So I'll see you in 15 minutes. And then we will cover the last point, which is about agency relationship. All right. And we cover agency relationship. Topic 1 is finished. All right. So we can have a break. So I'll see you in 15 minutes. Thank you. Okay. So that's the role and responsibility of management accountant. Now is a financial accountant or financial accounting. So financial accounting is a process to prepare a financial report. And why we have to prepare financial report? We prepare financial report for the external users, the people outside the company. Who are the external users? Shareholders, banks, government, supplier, customer, or maybe public. So these kinds of people are outside the company. They are external users. So they do not know what's going on in a company on a daily basis. So in order to provide them financial information, financial accountant is responsible for preparing a financial report. All right. And obviously, financial accountant will send this report to the CFO. CFO have a look and sign, and then CFO will send that report to the director. And finally, director publish or present the financial report in a market. Right. So this is the meaning of financial accounting. Why financial accounting is important? Because the users that I give you example, like as banks or governments or suppliers, these users need financial information to make a various types of decision. Because when we make any kinds of decision, we need information. So like bank gonna make a financial decision. So bank need a financial information regarding company to make a decision whether we should supply money to the company or not. Right. So that's why it's important to provide financial information to the external users. So financial accounting provide information to external users. So the idea is that management accounting provide information to the internal users inside the companies, and financial accounting provide information to the external users. All right. So that's involved in controlling or controller, and controller controlled by CFO. Right. So let's move on to the other side of CFO, which is the treasury or treasurer. What is a treasury? Treasury basically a cash related activities. All right. Treasury involves cash related activity. That's involved in treasury or the treasurer. So what's involved in treasury? Or treasury could be done by the treasurer. Treasurer is a person. Treasury is activity related to cash, right? Or the cash funding or the cash that company require on daily basis. Right? So what involves in treasury? So the first thing involved in treasury is a cash management or cash manager. Cash management or the cash manager. Company need a cash on daily basis to pay various kinds of bills. So it's very important to managing their cash in an organization. How we can manage by cash? By looking after the cash inflows and outflow of the company. So in order to make a balance between inflow and outflow, this cash management is responsible for managing the cash. All right. Next is a credit management. Credit management. Now, what is a credit management? You know that when company gonna sell its product, company has two options. Whether company sell product by cash, means company sell product now and company receive cash now. And the second option company has is company sell product now but receive cash later. All right, so this is called a credit sales. So credit management or credit manager is responsible for measuring the clients to whom we can sell product on credit, means those kinds of clients will pay us money later. And they also make a list for those clients who has to pay money right now. So no credit sales to those kinds of to do those kinds of customers. So why credit management is important? Again, in order to look after the company cash in and cash outflow. All right, we cannot sell all product by cash because maybe majority of customer they prefer credit. All right, so if we focus more on the cash sales, we lose customers, we lose the market share. Maybe our sales or profit will be affected. And we cannot sell all product on credit because if we sell all product on credit, we don't have cash to pay for regular expenses or some kinds of short-term bills, right? So that's why it's very important to managing the customer who will pay in cash or customer who pay cash later, all right? So that's called the cash management. Next is Forex management. Forex management. Forex stands for foreign exchange. So what is foreign exchange? Foreign exchange means exchange in a foreign currency. You know that some large companies, they do not only sell their product within the country, they also export product in a foreign country. Not only export, but sometimes they also import something from the foreign country. So when you are involved any kinds of trading or transaction with the foreign countries, you have to use a foreign currency. So, and foreign currency, you have to convert your local currency into foreign currency. For example, if you're selling product in a foreign country, you're going to receive money in a foreign currency, and then you have to convert in a local currency, right? Same thing when you are buying anything from foreign country, you have to convert local currency into foreign currency, and then you make purchases, right? So this is called, so the idea is that we need someone who can manage all these kind of foreign exchange things. Sometimes we are lending money from foreign countries, or we are borrowing money to the foreign partners. So again, maybe sometime foreign exchange exposure happen. All right, some kinds of foreign exchange estimation is required to calculate whether when we are selling this product in a foreign country, is it profitable or not, so on. So the idea is that all kinds of transaction, foreign related transaction or foreign currency related transaction will be done by the Forex manager or will be done under the Forex management, right? And the last activity or responsibility of treasurer or treasury is a CapEx. CAPEX, CapEx management. Now, what is that CapEx management? CapEx stands for capital expenditure. All right, now what is capital expenditures? You know that if you want to start a company, you need a capital, you need a finance. Once you go to finance, you're going to invest finance. So where you going to invest that finance? How you going to invest that finance? And after making an investment, how much finance is left? All this kind of recording and the decision things will be done by the capital expenditure managers. All right, capital expenditure means using money to make an investment or acquire resources that we needed to run and to start and run the company. right? So all these kinds of things and transaction will be done by the CapEx manager or capital expenditure manager. And that capital expenditure manager comes under treasurer, who comes under CFO, and CFO who comes under director or CEO. All right. So this is very general idea for this organizational structure. So always remember, it's not always that things happen in every kinds of company. Again, it depends upon companies to companies, but I'm giving you very general ideas for accounting and finance department. Okay. Now, if you have a look at the small and the medium company, small and medium company may not be organized in a such way. Why? Because in small and medium company, they have a less transaction. So that's why small and medium company, we may not have a CFO, like as in Vietnam. In small and medium company, we have a chief accountant. Chief accountant work as a CFO. But in large company, they may have a CFO, right? And if small company, maybe one person is responsible for treasury and controlling the things. Like as in some company, there is a financial controller. Financial controller is responsible for all these kind of treasury related things and tax and accounting related things. All right. So again, it depends upon the size of the company. Now we can summarize this organizational structure by allocating this, or by dividing this organizational structure into 3 parts. Right. So this is top management. Top management. Here is a middle management. And here is a bottom management. Now, top management is responsible for developing any kinds of strategy, planning, policy makings, code of conduct, procedure. They are responsible for that. So once they have decided the decision, once they have decided to produce the product and services, they contact to the middle management. So middle management can communicate that information to the bottom management. All right. So middle management basically they transform the information that they are receiving from the top management. So they're going to transform the information so the bottom management can easily understand. The very quick example for the bottom management is the workers who are working on a machine, worker or employees. All right. So they have a less decision power, right? And middle management, they have such kinds of decision power because top management are contacting middle management to communicate with the bottom management. So is in the middle management hand how they're going to communicate to the bottom management so they can understand what actually they have to do, right? So this is the organizational structure: top management, middle management, and the bottom management. Bottom management, we also call them bottom manager. We also call them sometimes frontline managers, right? Because they're working on the machines, like as I give example of the workers or the salespeople who directly encounter the customers, right? So that's the ideas regarding the organizational structure. So now let's move on to the next. Before we move on to next, anybody has any question? Any questions, or we move on to the next? Okay, so let's move on to the next, which is a goal of firm. So next is a goal of firm. Goal of firm means objective of firms. If I ask you what is the objective of firms, obviously you will say that objective of firm is making profit. All right, okay. But if I change my question by asking what is the primary goal of firms? What is the primary goal of companies? Primary goal of company may not making profit. Primary goal of company is to maximize firm's value. Maximize the firm's value. But now the question is, what is the meaning of firm's value? Maximize the firm value means maximize the shareholders' wealth. Maximize the shareholders' wealth means maximize the firm value. So here we have a two question. The first question is why? Why company primary goal to maximize the shareholder wealth? Second, if company primary goal to maximize shareholder wealth, how can we do that? How can we maximize it? So let's answer the first question. Why company or firm's objective is to maximize shareholders' wealth? You know that who are the shareholders? Shareholders are the people who are supplying money to the company. Why they are supplying money to the company? Because they want to make money. In simple words, they are investing money in a company. They are providing funding to the company. Right? So they are providing funding to the company. In exchange, company is making promise to them. The promise about return that company has to give to the shareholders. Shareholders, they are not asking whatever money they are investing in a company, they are not asking that all money back. No, of course not. What they are asking profit time to time. This is called return on investment. They are expecting high return over the period of time. All right. So company primary objective is to maximize the shareholder investment or maximize the shareholders return. That's why the company objective is to maximize shareholders wealth and firm's value. Okay. Now, why we call it maximize? What is it? Why we relate that firm value means shareholders wealth? Because firm value means obviously money value. Money value means capital. And capital is a combination of two things. Money we borrow from bank, all right? And the shareholders' money, all right? This money we return back to bank after a period of time. And whatever is left in a company, that's called the shareholders' money. If this money increase, so obviously firm money increase. Firm money increase, this money increase, or in other words, we can say that shareholders' money increase. All right. Okay. So that's why it's important for companies to maximize shareholders' wealth. Right. Now, Next is how we can maximize the shareholders' wealth. There are various ways to find out that how can company maximize shareholders' wealth. But we may not go in very detail because we have various other things to cover in this session. So here I will focus only on 2 ways to maximize shareholders' wealth. How can maximize shareholders' wealth? One is by increasing share price. Increasing share price. And second thing is maximizing profitability of the company. So increasing share price. How increasing share price will maximize the shareholder wealth? So shareholders' wealth, in order to understand shareholder wealth, how can we estimate shareholder wealth? It's a shares, number of shares, multiplied by market price per share. This is the total value of investment or the total firm value, right? And obviously, if share price goes up, the firm value also goes up. Shareholders' wealth goes up. So increasing share price will give a positive impacts on the value of the shares. All right, so that's why the people invest money in the stock market. If share price goes up, they make money, right? So exactly the same thing happened here. So you invested $50,000 in a stock market. If the share price or stock market goes up, your stock where you have invested, that stock goes up, your investment go up. You're making more money, right? But now the question is how share price goes up. So we can look at the 3 different examples. We have some more, but as I said, I'm giving you minimum examples. What are the reasons to boost the value of the share price? The first reason could be a profit, company's profit. If company profit goes up, the people or the potential investor who are looking to make investment, if they look that any company is profit is increasing consistently quarter by quarter or year by year, so what they will do, they will make a plan to invest money in that company. They demand for the share of that company because the company profit is consistently going up. If company profit is consistently growing up, if you have invested money in that company, you are making money consistently. Because if company maximize its profit, they give more return to shareholders. That's what exactly happened in that what they made a promise in the beginning of the business, that company give promise to the shareholders that you supply me money and we will give you consistent dividend over the period of time, right? So if company profit increase, the demand for the share increase. And the simple rule of microeconomics is that demand increase, price increase. So everybody or shareholders are demanding for the share of that company. As a result, share price goes up, all right? Second reason to increase the share price may be any kinds of good news. Good news about company. Maybe, for example, good news example here is collaborations. When local company going to collaborate with the foreign partners. And that's kind of good sign for the company, because if you collaborate with the foreign partners or biggest foreign partners, your company will grow very fast. And all the people who are looking for the stable investment, they will buy your stocks. And again, demand increase, price increase. Right. Third reason is any kinds of economic, we call it economic stability. Economic stability. So as you know that we just majorities of countries now, they are recovering from the coronavirus. And during the coronavirus or the pandemic, many countries' GDP are negatively affected. So why is GDP negatively affected? Obviously, many businesses, they cannot operate it because of the lockdowns. So it means that's kind of things affect the economy of the country. Similarly, it was a negative impact. Similarly, there could be positive impacts of economy growing. So positive, the example could be a foreign investment. If any country's foreign investment increase, this give a kind of provide the investment opportunities for the local and the foreign investor. As a result, more and more business setup, manufacturing setup, production increase, GDP increase, and so on, right? So any kinds of economic factors may affect the profitability of the company, because again, investment issues are related to the that kind of economic activities. All right. So any kinds of economic indicators, obviously positive economic signs give a positive impacts on the firm productivity. As a result, investment will increase. People more and more invest money in a stock market, or the demand for the companies. As a result, share price goes up. Right. Another reason, the second reason to increase the share price is maximizing profitability. That's, I think, I don't have to speak much about it. So always remember, if company making more profit, company will give more dividend to shareholders. Company will maximize its profit distribution among shareholders. So let's say here's a profit. This is the company total profit. And for example, company gonna distribute among shareholders. It depends upon how many number of shares you are holding. So total profit divided by number of shares. So that's your return on shares, or profit per share. Profit per share. So if company profit increase, as you can see here, if company profit goes up, as a result, profit per share increase, and depends how many number of shares you are holding. So let's say $1 per share, you are making profit, and you are holding, let's say, 10,000 shares. 10,000 shares, so you are making $10,000. All right, you're making $10,000. So that's the ideas regarding the maximizing shareholders' wealth. Right? So the goal of firm, or the primary goal of firm, is finished. So any question, or we move on to the next? Any question, or move on to the next? Any question, or we move on? Say something, any question, or we move on? Okay, so let's move on to the next. Now, next is a business ethics. Business ethics. Now, what is the meaning of business ethics? So in order to understand business ethics, we need to know what is the meaning of ethics. Ethics is basically, ethics means morality. Do the right things, right? Do not take any kinds of unfair advantage of someone else. That's the meaning of ethics, all right? do the right things. Now, what is the business ethics? Business ethics means rules and regulations or policy and procedure that require to conduct the business. All right. Rules, regulation, principle, policy, procedures required to operate and direct the business, giving the right directions to the business. If we have a business ethics, company is going in the right directions. All right. So here, I will give you 4 or 5 different examples of unethical behavior. Unethical behavior means we should not practice those kinds of things in our organizations, because these are examples for any kinds of unethical behavior or unethical events. All right. So let's start with the first example of unethical behavior. So remember, we are talking about unethical, not ethics. Unethical behavior. Right. So the first example is a creative accounting. Now, what is a creative accounting? Creative accounting means change financial information purposely. Change financial information purposely. We also call it manipulations. Manipulate financial informations. Right? Okay. Now, what is the meaning of manipulate? Manipulate financial information. It means using your skills and knowledge to change financial information in a such way that financial information give a positive impact on the people. Let me give you a very simple example. For example, company having a loss. If company having a loss, do you think people or potential shareholders will invest money in that company? Of course not. We just look at the primary goal of firms. Every shareholders, every investor, they want to look at the profitability of the company when they are making a financial decisions. All right. So if any company having a loss, that kind of loss may give a very negative impacts on the shareholders, or they may lose their existing shareholders because your financial position is bad. So instead of showing the real loss, company will show the fake profit to the shareholders. They are not simply doing a white lie. So they're gonna, as I said, manipulations, use their skills and knowledge in a such way so that information, they modify it, they change it. And of course, if they're modifying the information, that is completely unethical, because according to accounting standard, company must provide true informations among shareholders, among investors, or among users, right? But if you are modifying informations to look so good, look so beautiful, is no more truth. All right, is completely fake. So this is called a creative accounting, and this is completely sounds unethical. Not only unethical, but also it's illegal because it's breaking the accounting standard, breaking the law. All right. So this is called a creative accounting. So change financial information purposely, so you can give a positive impact on the people. That's called creative accounting. All right. For example, I don't know, let's say some student got F, but they did it A+. All right. So that's also example of creative accounting. Obviously, when you convert your F, which is fail, into A+ by doing this, then of course you have to change the answers here as well. So change the whole things. This is called the proper planning, professional planning. We did it, and obviously professional people, they're good at it because they know all this kind of informations and things to change it in a such way so that looks real for the other people, right? But again, it's completely unethical behavior, right? Now move on to the next. Next is earning management. Earning management. Now, what is earning management? Earning management means take the unfair advantage of their power to get personal benefits. Or in other words, we can say that apply such methods or policies to get personal benefits. Apply such methods and a policy to get personal benefits called earning management, right? So for example, inside the organization, of course, I'm not talking about the shareholder inside because they are external users. Inside the organization, management is the most powerful, right? Management acquire resources from the shareholders, and management apply those resources in the organization to maximize its profitability. But if management apply some kinds of accounting methods and policy, they may give personal benefit to the management only. That's example of earning management. All right, because management or anybody in organizations, their objective is not to maximize their personal benefits. Their objective is to maximize the shareholder wealth. But you are applying some kinds of system, some kinds of policies, some kinds of methods. They're going to give benefits to yourself only. So what does it mean? You are taking an unfair advantage of your power because you have a power to apply methods and policy. And you have a power, so you can apply those methods that can actually maximize the productivity or efficiency of the company. But actually, you are not doing that. You are applying the methods that may maximize your personal benefits. That's called earning management. All right. And again, this is not good because as we discussed before, everybody in an organization must be working in the best interest of shareholders. That's the objective or primary goal of the firm, or who are operating the firm or managing or doing any kind of administration in an organization. All right. So again, earning management is an unethical behavior. Third thing is insider trading. Insider trading. So in our previous topic, we looked at the meaning of corporate finance, and corporate finance can be explained by looking at the personal finance or personal financial management, or the corporate financial management. And as I mentioned in the previous session, is that we will focus on the corporate financial management instead of personal financial management. And in the previous lecture, we also looked at the form of business or the types of business. There are 3 different types of business: sole trader, partnership, and corporations. In addition, we also looked at the advantages and disadvantages of each form of business. So now let's move on to the next, which is an organizational structure. As I explained in the previous session when I was discussing about the advantages of corporation, then I mentioned that maybe in upcoming session, we're gonna look at the structure of organization. This is called organizational structure. Organizational structure means how company looks like. What are the roles and responsibilities in our organizations? So in which way roles and responsibilities are transferring from one manager to the another manager. Right? So that's called the organizational structure. So let's start with the organizational structure. So in organization structure, the first person is a founder. And who is a founder? Founder is a person who starts the company, who finds the company, who starts the company, who raise the ideas, who generate the ideas to produce any kinds of product and services. Right? So once we have a founder, now we need investors. We need someone who can supply us money. So obviously not bank, because bank, if you're taking money from banks, that's known as a liability. But we need someone who can supply us money, and we don't have to return that supplied money or principal amount to that person. So that person known as an investor or shareholders. So next person is a shareholder. So who are the shareholders? Shareholders are the people who supply the money to the company, and in exchange, they receive share from the company. So that's why we call them shareholders, because they are holding the shares. Right? So what shareholders do in organizations? Shareholders, they control the company. They control the company. Now, what is the meaning of control? Control can be defined by looking at two different types of decisions. One is a financial decision. And the second one is a operating decision. Financial decision and operating decision. So these shareholders are responsible for financial decisions and the operating decisions. So in other words, we can say that all kinds of financial and operating decisions are made by these people. Now, what is the meaning of financial decisions? In order to understand financial decision, we have to look at the finance. As you know, that finance is the amount of money that we need to start and run the business. In other words, we can say that capital. Finance means capital, and capital is a combination of, capital is a money, right? Like a finance. So capital is a combination of two different types of funds. One is a fund that comes from banks, borrow money from bank. This is called bank loan, right? And second one is we receive money from shareholders, right? So now, so that's the ideas regarding capital, shareholders, and the banks. Now, what is the meaning of financial decision? So always remember, capital is always 100, or you can call it 100%. So it means if bank loans are 40%, and obviously shareholders' investment will be 60%. So shareholders will control on company by 60%. All right. So if bank loan increase by 5%, then obviously shareholding will decrease by 5% because capital remain 100. All right. So financial decision means shareholders will decide whether company should borrow more money from bank or not. If company needs money for further investment, whether company should go to bank to borrow money or company should issue more shares in a market. Because if you know that bank loan is a liability, it's obligations, the money that you have to return back to bank with interest after a period of time. So if the bank loan size is getting bigger, and obviously shareholders or shareholdings will be reduced. It's not just about reducing the shareholding, but if the bank loan is keep increasing over the period of time, this is kind of like bad indicators about company financial performance or company financial management. Because if bank loans are increasing, company fixed liability is increasing, company future obligations will be increasing. So company has to work hard in order to make that fixed payment to the bank. So if any company has a high banks in very general way, but not all the time, but if any company having a very high bank loan or had any kinds of high liability, that's kind of bad indicators regarding company financial management system or company financial situation. So the idea is that the balance between that shareholders money that we get it from shareholders and the money that get it from bank, that balance will be depends upon the decision made by the shareholders. All right, whether company should borrow more money from bank or not. So this is called a financial decision. So shareholders will make such kinds of financial decisions. All right. Now next is operating decisions. Now what does it mean, operating decision? Operating represent product and services in relation of product and services. Any kinds of decision regarding product and services that also will be taken by the shareholders. For example, if iPhone company wants to produce iPhone 12 or iPhone 13, iPhone company need to take approval from shareholders. They have to convince shareholders that why we should produce iPhone 13, how iPhone 13 is a different than the iPhone 12, 11, or the previous model of the iPhone. All right. So they have to take permissions from the shareholders. But now the question is why they have to make permissions from the shareholders. Answer is because shareholders, they are investing a lot of money in a company. And what we do with that money? We use that money to produce product and sell product. So if product is failed, shareholders will lose their investment. So that's why the money that we are using to produce product, that money belongs to the shareholders because they are supplying to the company. So it's very important for a company to take approval from shareholders regarding any kinds of product and services. Not just simply approval. You have to convince shareholders by arguing that this product is quite unique or this product going to maximize the company productivity or maximize the company profitability. Hence, shareholders will maximize their investment as well. So that's the meaning of control. All right. So that's why you can see that how powerful shareholders people are in companies. So in other words, they are the real owner of the company because they are controlling. Whoever controls the company owns the company because shareholders own the company. So they also, sometimes we also call them the owner of the company. Right? So once we got the funding from the shareholders, now we need someone who can run the company. Shareholders, they don't run, they simply invest money in a company. So we need a professional person who having a lot of experience, knowledge in order to run the company. All right, who is that person? That person is known as director or CEO. Director or CEO. CEO stands for Chief Executive Officer. All right. So what is the role of CEO in an organization? Obviously, CEO is responsible to run or manage the company. Manage the company, run the company, giving the directions to the company in a right way. or giving directions to the company in a right way so company will be able to achieve its mission or vision. All right. Manage. You know that shareholders are the people who are supplying the amount of money to the company, right? So who gonna use that money? Director will use that money for what? To acquire resources. Whatever resources director require to run or achieve the company objective, director will use that money to buy that resources. The quick example for resources is your assets, land, building, plant, machinery, right? How director gonna use shareholders' money to acquire that resources and utilization of resources to maximize the productivity and profitability of company. That's the not simply, but that's the role of the CEO and the director. Sometimes we call it director, sometimes we call it CEO, sometimes we call them managing director, sometimes we call them vice president, sometimes we call them chairman, different names. Right? But generally director or CEO, known as the person who is responsible for all kind of operating activities in a company, operating obviously related to product and services. Right? Any kinds of things happen in a company, director will be responsible. Director will make decisions. Right? But of course, some kinds of major decision regarding product and services or regarding financial decisions, obviously director need to take approval from shareholders, as I explained about controlling. All right. Okay. So now you know that director is a person who alone cannot run the company. All right. The director need other people who come from the different backgrounds or different expertise in a various fields, like as maybe human resource, maybe in marketing and sales, maybe in account and finance, maybe in IT, maybe production, maybe purchasing, various kinds of line of interest people must become on. All right. So now director appoints various people who work in a various fields or various departments. For example, human resource department, maybe marketing and sales, maybe accounts and finance, maybe IT, maybe production or purchasing, and maybe production. So on. It's just example. I'm not going to focus on each and every single department in the company. I'm just giving you overview of the organizational structure. All right. So director control or appoints all these types of people from the various fields. Now, obviously, we need some other people who are working in this department, in the human resource department, who is responsible for managing people or workforce, marketing and sales responsible for advertising or maximizing the sales of companies, accounting and finance, controlling all the financial things and issues that we discuss later. IT department, all kinds of information system or information technology related things will be controlled or will be managed by IT department. And finally, purchase and production, whatever material we require to produce product, purchase department is responsible, and then production department is responsible by using that purchase material to produce product services. All right. Now, there are various kinds of departments. So obviously, we will not speak on these departments in very detail. We simply focus more on the account and finance department because we are covering only financial management in this subject or this topic. So focus more on the accounts and finance department. What actually happened in accounting and finance department, which kinds of person is responsible for which kinds of activity, right? So first of all, who control the accounts or finance department? The person who is responsible for accounting and finance department is a CFO. CFO. CFO stands for Chief Financial Officer. All right. Now, here, Chief Financial Officer has two different kinds of activities here, right? Two different kinds of roles and responsibilities here, or what CFO is responsible for. So, CFO is responsible for two things here. One is for controlling, and the second thing is for treasury. Right. Controlling. Controlling involves three things. Which three things? First is a tax management. Tax management. Tax management, or controlling involve a tax manager. So what is a tax management? So you know that company has to pay various types of taxes, such as corporation tax. Company make a profit, and company has to pay tax on profit. Company purchase raw material within a country. Company has to pay VAT, value-added tax. Depends, but they also can get some exemptions later, but that's tax subjects that we are not discussing. We just make it simple that company purchase raw material, company has to, raw material supply or anything that company is buying, company has to pay value-added tax. And sometime company, because when company pays salary to their employees, company keep the tax of employees, and company is responsible for depositing that tax to the tax department, to the government. And that's also company involved in that kind of tax things. And another thing is that sometimes company is buying or import some kind of material or some kind of supplies or some kinds of equipments or assets from the foreign country. And obviously company has to pay import duty on it. Depends upon the nature of the material or the assets company is buying. But generally company has to pay import duty on it or import taxes on it, depends upon countries to countries. So again, tax things. So the idea is that company needs someone who can look after all these kind of tax issues. And of course, we cannot take these tax issues very lightly, because obviously government quite strict over all kind of tax system. If any company do not able to pay tax payments on time, obviously company has to pay some penalties to the bank, or maybe government gonna take very strict actions to the company if company miss any kinds of tax payments or the tax deadline. So we need someone who can look after all these kind of tax issues. So this is called a tax management. And obviously tax manager is responsible for tax management. And maybe tax manager requires some other people in that department, assistant or some other people who also help tax manager to manage the tax. All right. Second thing involved in controlling is management accountant or management accounting. Management accounting. And the third thing is the financial accounting. Now, management accounting. Management accounting is a process to provide financial information to the people within the organizations. Or management accountant is a person who provides all kinds of financial information within the companies. So for example, a company planning to produce this product, what will be the cost of this product? What will be the price of this product? What will be the profit of this product? That kind of recording system will be done by the management accountant. All right. I'm giving you very simple examples to understand the management accounting, all related to a cost, any kinds of planning in relation of the cost, any kinds of planning, maybe to acquire a particular assets, all right? To assess whether this project is a profitable or not, to invest money, that also done by the management accountant. In simple language, management accountant provide financial informations to the different people in a different department. all right? Because people need information to make a various kinds of decision within the organization. So management accountant or accounting is responsible for it, all right? And or management accounting or management accounting. Accounting is the process to provide information to the